War and inflation knock world economy off balance. Dow Industrials hit 2022 low on worries over growth. Stocks remain under pressure as yields set uncomfortable record. Do these headlines actually describe what's going on? And how much worse could it get? We'll discuss today on Open Interest. So last June, I was joined by my good friend and longtime colleague, Professor Mark Guthner of Rutgers University, co-author of The Options Edge. Given what has happened since we did that video, and we'll provide a link to it somewhere here, and if you haven't watched it, I encourage you to, it seems appropriate for us to revisit that conversation. What we were discussing then was what is the sensitivity of equity prices to changes in rates? How high could rates go? How low could equities go? Here we are. Rates have obviously gone up quite a bit, and equities have fallen quite a bit. But before we say that this is all over and this represents a buying opportunity, I think we need some context. I had a chart I actually discussed in the last video where we talked about this, one area of inflation that we had seen, and one of the things that the Fed is responding to. And I'd like to show a time series of that if we could. And what it is the median home price in the United States versus the median personal income over the course of the last 50 years. And here's a chart of it. What you'll notice is that right before the credit crisis, everybody knows we had a housing bubble. At that time, we reached essentially all-time highs in terms of housing prices relative to personal income. The credit crisis helped correct some of that. We actually saw home prices fall closer to the longer-term mean, if we were using that as a metric. But of course, we've kept rates low for a long time, and we reinflated that bubble. And then, during the pandemic, we created even more money, and we are now at all-time highs. We're looking at almost 12 times median personal income for the median home price in the United States. Now, the reason I bring this up is because I think it's important for us to understand. This is very painful what's going on. If we're looking at equity prices, what we're experiencing is going to be quite painful for people's equity portfolios. But real harm has been caused. And if the Fed's going to do its job, it has to undo some of the damage it has done. That's where inflation really impacts folks. So, Mark, what are your thoughts as you think about where rates are now, where they should go for things to essentially normalize, which is a word actually that Powell himself has used, and how much further could equity prices go lower if they get to the levels you're thinking of?
Well, there's a couple of things to think about here, Mike. One is people and academics, economists, think that what the Fed needs to do is get the nominal interest rate above the inflation rate so that there is a real rate of return provided to investors. And so that's one way to look at it, but I think there's also a dynamic going on between stocks and bonds in real estate and risk assets in general. There's a dynamic that goes on there. And so as we see interest rates going up, we're seeing stock prices fall, and we have a risk now that there'll be a dislocation in the equity market, and the Fed would not have to raise interest rates above the current, let's say, 8.5% rate of inflation, which is what they measured year over year in through August. So we're at a dicey little point here right now, where if equity prices continue to fall, maybe the Fed goes on hold, before they make the next change. But if the equity markets hold up here, they're going to continue to raise rates.
I mean, wouldn't it be fair to say that equity prices, like housing prices, similarly were an inflated bubble? I mean, what we were seeing was that bond yields were at historical lows. We saw very narrow credit spreads. If we thought about it this way, what would it cost for somebody to retire and earn an income off of an investment portfolio? It was essentially all but unaffordable at risk asset prices that we saw only just recently. If housing prices are still grossly too high, and if equity prices are still historically high, can they use even just the pullback, a 20% pullback from an exorbitant number doesn't necessarily mean the problem's been corrected. But you think that the Fed may essentially chicken out then and pause because of that?
Well, I'm thinking that if we get another 10 or 15%, they might chicken out. As if equity prices kind of stabilize where they are right now, then in the next Fed meeting, they're going to raise rates another 50 or 75 basis points. But as you can see, equity prices are not dealing well with higher rates now. And we've seen a number of days in a row where the Dow Jones falls by more than 500 points. I think, I didn't look at the numbers quite at the end of the day, but I think the S&P was down 100 points today, a couple of percent. If that continues, I can see them being on hold. If it stops here, we say, okay, everything stabilizes, they're going to continue to raise rates because inflation is going to continue to plow ahead. You know, the markets might do the Fed's job for them if it fell, let's say, 15% from here, because people's spendable assets are going to be down, their wealth is going to be down, they'll be spending less. We've probably tip into recession. Spending slows down, and that might give us a little reprieve on the front of the inflation numbers.
So we've seen, how much have equities actually declined in total? So if we think about it, the Fed's balance sheet, I think, reached what, 8 or 9 trillion, right?
Right.
So if we sort of think of that as money that flowed into the system, and if we think of declines in equity prices as money that's kind of flowing out of the system, where do you think an appropriate balance is found? How are equities priced right now relative to our economy in general?
Well, I think that equities are still on the expensive side. We do have a slide that shows, I think, the price of equities relative, let's go to the next one, relative to GDP. Oh, there's a third one, I guess, that never got put in there.
Yeah, I mean, I think that's something that Buffett often talks about, right? He talks about the value of, the aggregate value of the U.S. equity market to GDP. And where does that stand right now? Maybe we don't have a graphic to show, but where does that stand, and where is that on a historical basis?
Well, it's about a little over 150% right now. And Buffett has always mentioned that 100% is his idea of a fully valued stock market. So we have ways to go, and we're far higher than where it was, or a little bit higher than where it was at the peak of the dot-com bubble in 1999, and substantially higher than the level it reached in 2007, just before the financial crisis started.
Well, since we had that other chart up, maybe we should pull that up again, and you can talk to us a little bit about what this one shows us.
Well, this I wanted to add to your analysis in the real estate market. One thing that I think is interesting, how expensive real estate got in just 2 years, and bear in mind relative to that affordability factor, and bear in mind that was occurring when interest rates were falling. Now, this is a rather interesting chart. Now, the Fed is charged with trying to moderate or drive the economy with monetary policy. I think that's an extraordinarily difficult and perhaps even impossible task, because 1 trillion transactions take place every day, and the Fed's trying to figure out what's the proper amount of economic activity and so on. So even if they had perfect data, they have a significant challenge. But in this chart, what I like to show is that I think the Fed is working with flawed data. So the thin red line here shows the year-over-year rate of change of real estate prices based on actual transactions. And you can see that's up a little bit more than 20%. Now the line below that is the component of CPI that represents real estate inflation. And it's based on something called owner's equivalent rent. And so the way the government gets this number is they call a few 100,000 people and they collect some data by asking the question, what do you think your house would rent for? And so they take that number, average them up and say, oh, this owner's equivalent rent is up about 7.5%. So you can see housing prices did one thing, and people's perception of the rental value of their house is something else. And I think if the Fed was focusing on real transactions, maybe they would have taken their foot off the accelerator a year earlier than they actually did. So if you're looking at data that's telling you, oh, the real estate's going up 7.5% a year, that's not, an enormous dislocation, if you will. But at 20%, that's way too fast, and they might react. Now, if we take the fact that the real estate's a little over 30% of CPI, take 30% times 13%, and it doesn't take much imagination for people to figure out that the CPI figure is probably an underestimate of the rate of inflation. So if the Fed doesn't have a real sharp pencil on inflation, how could they possibly hope to make decisions to modulate it?
It's interesting because one of the things that Powell discussed this week was that he believed that some correction was necessary in the U.S. housing market. And I find it extraordinary that he would be saying that now when we consider that U.S. housing prices have risen 40% in the last 2 years.
Yeah.
And we've all been observing this in real time. People have been watching this happen. And how the Fed could actually, I probably sound a bit exasperated as I say this, how they could bring up now that they think that there's a problem in the housing market. I'm absolutely flabbergasted, to be honest, that it would take them so long to publicly acknowledge that and to also acknowledge that maybe they were partially responsible for this. But I guess the long and short of it is that if the Fed is going to act to correct past wrongs, including what they've done to the housing market, then I think it would also be fair to assume that the damage to U.S. equities is not over. The real question here being whether or not the Fed has the stomach to try to correct what they've done, rather than go part of the way and hope that a combination of narrative and publicly traded equities will take care of the rest of the job. Is that your assessment too?
It is,
you know what?
I
think I was just told by the producer that we actually got that stocks value versus GDP chart that you were talking about earlier, and maybe you can just outline it here. We can actually give this some context now relative to time, and this is really interesting because we actually show some past bubbles in there, including the tech bubble.
Well, that's right. We see the tech bubble there, and the number is pretty just a little bit under 150. And then we know that the S&P came down. I don't remember the exact numbers, but something like 40 or 50%. Nasdaq, on the other hand, was down, I think 85%. And Lord knows a whole lot of .com companies no longer exist. And so that drop was rather swift. But take a look where we are today. The Monte printing and the expansion of the Fed's balance sheet from the bottom of the financial crisis, run stocks up relative to GDP to just a hair under 200%. Never been this high before. And then look at where we are now. So we've come down about 40%. So we're about 160. We're still above the 2000 high, and we're way above the high seen in 2007, just before the financial crisis took hold. Now, the scary part of that chart is what happens if we go back to average. If we go back to average, we have another, 60%. So the stocks are going to have to fall another, say, 30 or 40% just to hit average. I think if stocks did that over a year, maybe 18 months, I think the Fed would feel like that they ran their monetary policy right and sort of deflated the bubble on a measured pace. I think what I fear now is that we're actually getting a popping bubble, and that correction takes place in a matter of 3 or 4 months, which is what I was mentioning before, and you were asking about is, will the Fed keep their nerve? So if it happens slow, I think they keep their nerve. If it happens fast, I don't. It's not their history. We know that we go back to Greenspan and the crash of '87. They printed a lot of money to stop the implosion, and they did the same in 2001 and 2 to bring that bear market to a halt. So, that's sort of where I stand on that at the moment.
It's interesting that you mention that, and that chart is kind of illustrative in another way too, which is that the last time we had inflation rates where we are now was 40 years ago. And a little over 40 years ago, which is before Paul Volcker stepped in and actually did try to squash inflation and had aggressive policy action at the Fed. What a lot of folks who are investors in the market now may not remember was just how cheap equities became. In the 1970s, in the bear market of the 1970s, single-digit PEs were not uncommon.
The norm.
Equities became incredibly cheap, and that makes perfect sense because, of course, there's a relationship that has to exist between the earnings yield on equities and the yield, the ostensible yield on debt. So what we are going to see, potentially, if we don't actually get a handle of this, is that equity prices could get much cheaper, I think, than people are used to seeing if they look at it on that kind of a multiple. Anyway, for those of you who didn't see our earlier video, I really encourage you to go take a look at it. We will, of course, post a link. And Mark and I are going to try to do some other videos in the near future where we can continue to take a look at this. And maybe we'll get into some more stock-specific stuff as well as we do that. Thanks very much for watching. And Mark, thanks for joining.